Question 6 of AFM BPP revision kit. So this question is also very similar to question 5. This is about ratio analysis. You have been given some information, financial information, income statement and balance sheet, and you have to find the ratios. There are plenty of ratios here. So make sure that you're very good in ratios before you attempt these questions, right? So it's very similar to this question, but we'll also try to solve this question. So Tilton Company is a listed company which has traditionally manufactured children's clothing and toys with long lives. 5 years ago, it began manufacturing electronic toys and has since made significant investment in development and production facilities. The first, okay, the first electronic toys which Tilton Company introduced into the market were received very well. Partly as it was seen to be ahead of its competitors in being the made of the most of the technology available. The country where Tilton is listed has been seen a significant general increase in share price over the last 3 years. So it has seen a general increase in share price over last 3 years. Okay, the country where it has been listed, with companies in the electronic goods sector showing particularly rapid increases. So that means companies in electronic goods, they are showing rapid increases. Statement by the chief executive. Assume it is now September 2003. All right. Tilton Company's annual report for the year ended 31st March 2003 has been published. His chief executive commented when announcing the company's results. I'm very pleased. See, whenever some executive or some senior positions in the company, they make a statement or they make some announcement, please always underline or highlight those announcements because you will need it. Make use of those announcements, make use of those statements by the senior people because it means a lot. It will help you in your building your answer. So here they are saying, I'm very pleased to report that revenue and gross profits have shown bigger increases than in 2002, resulting in higher post-tax earnings and our company being able to maintain increase in dividends. So they are saying pleased for revenue, gross profit, okay, and also higher post-tax earnings, increase in dividends, the sustained increase in our share price. So increase in share price also clearly demonstrates how happy investors are with us, right? Whenever the share price, yesterday's one, the one question 5, we saw that the share price was not increasing, it was reducing, so the investors were skeptical, they were not happy about it. But in today's case, we can see the share price is increasing. Whenever share price is increasing from year to year, investors will be happy with that, right? So our cutting edge electronic toys continue to perform well, right? That means electronic toys, okay, let me mark this in red. So electronic toys continue to perform well and justify our sustained investment in them. Our results have also benefited from improvements in operational efficiency from our older ranges and better working capital management, right? So they're saying better working capital. Please mark this. You will need this when you do your ratios to explain why something increased or why some ratios decreased. That time you will need the statements. Let's say you are doing liquidity ratios and you are seeing it improved. Why it improved? You can use this line because they are having a better working capital management and also improvements in operational efficiencies for our older ranges, right? Older ranges. We are considering the development of further ranges of electronic toys for children or developing other electronic products for adults. If necessary, we may consider scaling down or selling of our operations for some of our older products. Okay, Steve Slinden represents an institutional investor who holds shares in Tilton Company. Is doubtful whether share price will continue to increase because she thinks that Tilton Company's situation may not be as good as chief executive suggests, and because she believes that current share price levels generally may not be sustainable. Our financial information has been given for the last 3 years. So this is the financial for 2001, 2, and 3, right? All amounts in dollar million. This is very important. Always see, right? But when you write your answers, right? When you do calculation, it's okay. You can forget about the millions and just work in numbers. But when you write your discussion, you need to write in millions. You need to write in your final answer. You cannot use these numbers, right? You have been given the income statement. You can see the income statement and you can see, right? your sales revenue is increasing, your gross profit is increasing, your operating profit is increasing, your finance cost increased, tax increased, right? So profit after tax increased, profit before tax increased, even your dividend increased. Now let's go to the balance sheet. Even this is in dollar million, right? You can see your non-current increased, cash almost remains same for 2002 and 3, other assets reduced, right? Your non-current liabilities increased, your current liabilities increased, and these are some other information. Just check the market price, the same like yesterday's. If you are able to solve question 5, you shall be able to solve question 6 also. In fact, I advise you that please attempt question 5. Maybe you can check my video or you can check the answers or whatever it is, but when you attempt question 6, don't look at anything, just do it by yourself and see where you stand. Are you able to do a justice with it, with the understanding of question 5? Because it's just the same way, only the numbers or figures are changed, the case studies change, the name of the company is changed, the rest all is same. The ratios, the way you have to do ratios and all is same. You have been given the market price, right, for 2002 and also 2003, the earliest and the latest. It is 2.5. This market price per share, if you see, where am I? Okay, I think okay, I'm sorry. Okay, so if you see this 0.05, don't get confused, this is not the share price, this they are saying this only, each share is 0.5, right? Don't get confused with that. So the price for 2000 is 2.5, whereas in 2001, if you see, this is 2.5, this is 2.76, it increased. Then from 2.76 it increased to 3.49, then it increased to 4.44, then it increased in September 2003 to 5.06, which is good. Share price is increasing, right? EPS is given to you, EPS also increased, dividends per share, dividend also increased. Right now, analysis of revenue, if you see, for electronic toys increased, non-electronic toys increased, clothing also increased, right? Gross profit, right? If you see the gross profit of all the three toys and the clothing, all the two toys and the clothing, it increased, right? Now let's see, there's a note, none of the Tilton company's loan finance in 2003 is repayable within 1 year. This is very important piece of information. It will tell you when you calculate your gearing ratios and all. When you calculate your gearing ratios and all for debt and all, you need this information. Okay, so loan finance in 2003 is none. Okay, they are saying none is repayable within 1 year. What does it mean? It means it's a long-term loan, it's not short-term, right? If you take any loan in 2003, it will not be repayable within 1 year, none of them. So it's a long-term liability, it will be placed under long-term liability, not current liability. Now let's see what are the two requirements. If you see requirement A, it is 20 marks. It's not a game. 20 marks, easily you can score this marks if you just keep on practicing your ratios. Every day you have to do some ratios, not just ratios, just calculate one, memorize it, it will not work. In daily basis you need to practice, you need to check your speed with the time, how fast are you able to calculate, right? Let's say in 20 minutes, how many ratios can you calculate in 20 minutes or 10 minutes, then also explain them, right? So you need to check yourself against the time, how many ratios can you handle and do. So evaluate, again this key comes, evaluate. That means you have to talk about the advantages, the disadvantages, the good and the bad side, and finally you have to give a conclusion. Like question 5 itself, Tilton's performance and business prospects in the light of chief executive's comments and Steve Tilton's concerns. Here you have to take two chief executive comments, right? In the light of chief executive comments and here's concerns, right? Chief executive told the company is good, share price is increasing, profit is increasing, revenue is increasing, but Steve Tilton's concerns is whether the share price increase, will it be sustained? So under both you need to evaluate the performance. Provide relevant calculations for ratios and trends to support your evaluation. 10 marks are available for your calculation. That means 10 is for your discussion. Part B, 5 marks. Discuss how behaviorable factors may have resulted in team. Yes, This I need to tell you that whenever some share price is given to you, share price increase or why it is so high, why it is too low, there's a possibility that you might be asked about the behavioral factors relating to share price, because this question I have seen, I think 3 to 4 times I have seen in the past paper. So you should know something about behavioral factors which leads to the share price being very high. This type of question has been asked, right? And mostly it has been asked for around 5 marks. So at least you should know 5 behavioral factors which can lead to the share price increasing. So discuss how behavioral factors may have resulted in Tillinton company share price being higher than it is warranted by a rational analysis of its position. For that, 5 marks. That means 1 mark for each point. Now we'll see the, before we go to the answer, let's go to the marking scheme. We have to read this, right? So the easy marks, the ratio analysis required here should have been a source of easy marks. Part B is also relatively straightforward in terms of applying knowledge of behavioral finance theory. So part B, if you see, is just you are applying your knowledge of behavioral finance. That's it. Examiner's team comment. Let's read. Every candidate should have aimed for the 10 marks available on the calculations. As oldie, a mark is typically awarded for ratio calculation. Candidates who calculate well in excess of 10 ratios have done extra work without gaining more calculation marks. Excess of 10 ratios is not needed, because only 10 marks are there. So if you have done more than 10 ratios, don't think that you are going to get extra marks, because calculating too much of ratios and writing very little discussion will not give you marks. It has to be balanced. Your ratios has to be balanced with your discussion. 10 discussion points, 10 ratios. That's it. So equally, some answers produce only few ratios or did not examine the full trend. Doing so means that they obtained few marks than they were available. Some answers simply share a percentage or a figure without any workings at all. Just simply they showed a percentage of figure without any workings. No. Whenever you have to do ratios, you have to show workings, you have to write the formula. Don't do it without it. Just don't write the final answer. I know you know the formula of the ratios. Just don't use your calculator and just put the final answer. Show that working. How you got that current. Let's say you're working on current ratio. How are you getting that current ratio? Current assets divided by current liabilities. Write it down. Then write the figures there. Current assets divided by current liabilities. Then you find the final answer. Why this is needed? Because in case your final answer is wrong, you will get marks for your working. The examiner knows that you know the working. It's just maybe due to some error, arithmetical error or something, calculation you got wrong, but at least you're working as correct, you will get marks. You will get marks there. But if you don't write the formula, right, if you just write the final answer and if that answer is wrong, how can the examiner give you marks? Tell me. You haven't written anything. Examiner cannot give you marks where you have not write anything. They can only give you marks where you wrote something. So always try to show your full workings, because workings you are getting marks for each working. Right? So this meant that it is often difficult for markers to see how the ratio was arrived at. Therefore, own figure rule cannot be awarded when the same mistake is applied to calculating another related ratio. Exactly. Let's see your first ratio is wrong. Based on that ratio, you have to calculate another ratio. So that ratio also will be wrong. Here, you will be penalized twice. Your first ratio, you are getting, your marks will be cut. You are not getting marks. Second, also you are not getting marks. But if you do working, right? If you do the working at least, if your first answer is wrong and based on that you are using a second answer, you will only be penalized once because you have shown the working. So that is the advantage of using working over there. You are not being penalized multiple times, only once for writing the wrong answer. So that own figure rule you cannot apply when you are not putting any workings. And also what is disappointing here is to see answers which use the wrong formula to calculate basic ratios particularly. These are some ratios. Okay, let me highlight it. Return on capital employed, asset turnover, current ratio, gearing, price earning ratio. So these are some of the ratios where formula has been wrong. Please pay attention to the formula which you are using. That's why I always tell you, try to do as much questions in ratios as possible so that you can see the types of formula they are using. The more you start practicing ratios, That formula itself will be in your mind, behind your mind when you do the ratio. Every time you don't have to memorize the formula. Once you memorize it, once you practice it, second time when you do, you automatically know what to take. What is the formula? You don't have to memorize each time. Okay, so or mixed up dividend yield without payout ratio. So this ratios and the interpretation are considered as assumed knowledge from the applied skills level. Please mark here. This ratios you're not learning in AFM. This ratios you have learned before. They are now considered as assumed knowledge. You are assumed to have this knowledge at this stage. So if you are not so good with ratios, please go back and revise your ratios. Revise your ratios. And now Google is there, so work is very easy. You can just find from Google, find the ratio, find the formula of the ratio, and write it somewhere and then memorize it. That's it. Now you don't have to go back also because Google is there, so our work became very much easier. Just use it. Okay. So answers which interpreted and discussed ratios calculated with reference to the question scenario are provided inside scored high marks. However, all too often answers earn very few or more marks for evaluations because they merely distribute the increase or decrease in ratios. So please don't just write, again I'm repeating, I have been repeating this many times, don't just write increase or decrease a ratio. Why? And part B. In part B, candidates were asked to discuss how behavioral factors may have affected the companies higher than expected. There were some excellent answers suggesting that candidates may have read the AFM technical article published on this topic area. Technical article. Please go and read your technical articles. There is one technical article in AFM about behaviorable finance or behaviorable factors. Go and read that technical article from your ACCA website. Right? Because you're not going to be asked any numerical questions on behavioral factors, so it will just take around 5 to 7 minutes for you to read that technical article, or maybe max is 10 minutes. So just spend some time, read the technical article so that you will have a better understanding of behavioral factors. Right? So these are the ratios: profitability, liquidity, solvency, investor, other ratios and trends. Same like question 5, no difference. Discussion also you are going to discuss, and you are finally going to write calculation. And if you see the marks how they are divided, it is divided equally, 2 to 3, 2 to 3, 2 to 3 for each ratios, right? And if you see profitability, it's 3 to 4 because there are more ratios to calculate in profitability compared to the other ratios, right? And here if you see it's just liquidity, one only, maybe there's just one ratio in liquidity, so you're getting 1 mark, right? And here if you see here this, and this is the investor ratio, by the way. For ratios, when you calculate, if you see in your calculation part, when you calculate ratios, investor ratios you have to focus more on, because that ratio, that set of ratio will have more ratios. In the AFM, right, you have to work more on your investor ratios. That's where the key is. Does not mean that you have to forget about the other ratios. Other ratios are also important. Every ratio is important, but investor, you'll be getting more marks for that, 3 to 4. Whereas other ratios are just 1 to 2 or 2 to 3. That's it. Right? And so let's, this all they have, these are the discussion. First, we are going to go through the calculation and then discussion, right? Because without calculation, it's not possible that you can go through discussion. It is not possible. But when you get in the paper, exam paper, keep some space, 1, 2, 3, 4, whatever page number keep, and then start doing your calculation under appendix. Right? So you see for each there are different subheadings: profitability, which is divided into different paragraphs, and then they talked about liquidity, then they talked about solvency. This I cut because I just copy pasted the same thing. When I pasted here, it was the same thing repeated. That's why I cut, for you to not get confused, right? Investor ratio, then the conclusion, right? So now first we are going to go through the appendix, right? When you go through the appendix, the profitability, right? Percentage increase in revenue, right? Why it's not for 2001 here? Why it is not here, given here? Because you are just finding the increase from 1 year to the next, right? You have not been given the revenue of 2000 to find the percentage increase in 2001. That's why it is blank. You're already having 2002 to 2003, the percentage increase in revenue, right? How you are going to get that percentage increase in revenue, I will show for one, and likewise you can do for the other one. So here where the revenue was given. So here the revenue has been given for the 3 year. So just see the sales here. If you want to find from the change, so the difference is 1636 minus 1385. This is for 2002 you are finding, divided by the old price, which is older revenue 1385. You shall get 18.1% as an increase. And likewise for 2003 you should be able to do using 2003 and 2002's figure, right? And it's a percentage increase in revenue. So we are done with this. I'm just ticking off the ones which we have completed so that it's easy for you to know where we are currently. Now we are in the gross profit percentage. Please, whenever it's an increase only, you will not have for 2001, but when it's a gross profit margin percentage, you will have for all the 3 years. Gross profit is gross profit divided by sales. So that's also easy. I'm not going to show how. Just check yourself whether you're getting these figures. Percentage increase in gross profit. That also you can work out from there, like how we did for sales. From 1 year to the next year, you just compare. Operating profit percentage, right? That is operating profit divided by sales, the formula. And then how the percentage increase in operating profit. That also you can check out how we did for revenue and gross profit. So if you see whenever the increase is there, this word increase, it will only be for the 2 years, not for 2001. It's not here, it's not here, it's not here. Because for that, we need the previous year's figure. Now, all of these are profitability. Asset turnover. Your asset turnover, the formula is given here in the bracket itself, revenue divided by total assets minus current liabilities. So your total assets includes both your current and non-current assets, right? So I don't have to show how you got the asset turnover. The formula is given. From there itself you can work out. And also the return on capital employed has been given. The formula is operating profit percentage, right, into asset turnover. Let's work out for the 2001, and the other 2 years you can work on yourself. So for 2001, what was the operating profit percentage? You don't have to go back and check. Just now we calculated here. 14.8. Multiply by what was the asset turnover? 0.65. Just check, are you getting 9.6 or not? You should get 9.6. Right? You are getting 9.62. So I rounded up to 1 decimal place. Now let's go to the liquidity. Liquidity is very easy. Current assets divided by your current liabilities. So that I don't have to show you. Solvency. Let's go to the solvency. Right? Solvency gearing percentage is given to you. Non-current liabilities divided by non-current liabilities plus market value of share capital. And here there is another gearing percentage. There are two gearing. One is you're taking the market value. Just see. Here you're taking the market value. Here you are taking the book value of the share capital plus the reserves. You are taking two gearing percentage. Right? And interest cover. Interest cover is your operating profit divided by your finance cost that you will get from the income statement. So you know how to calculate. So even this is done. But the other two, I will show you how you are getting it. Right? Book value of share capital plus reserves. So for gearing, where should we go? Immediately we have to go to where? We have to go to the income, the balance sheet, right? So what is your non-current liabilities from there? It is 920. And what is your share? Let's take the market value of share. I am also calculating now, so you also calculate and check. I'm giving you some time so that you get that 29.4. You must be knowing this because the same way we have done for question 5 like this yesterday, the market value part, but not the book value, right? First, we are finding for the market value. Market value of share. Percentage is the market value of share. right? Okay, so here, this is a little trick here today in this one. Okay, just read. So if you want to find the market price per share, always you have to multiply that by the share price, right? So first, if you have to get this, it will be 400 divided by 0.5, right? Because 0.5 here. Multiply this by what is the share price for 2001? It is 2.76. What is this answer? It is 2208. So share is 2208, right? Your long-term liability is 920. Yeah, your debt plus your equity, which will be 2208. Hence, you are getting 29.4% using market value, right? Likewise, you have to do for 2002 and 3. Now let's go to the book value. Book value, how you are doing, right? How you are doing book value. I'm giving you 1 minute to think and try this on your own how to get the book value. Your long-term liability, right? Non-current liability. The debt will be 920 only. What will change is only your equity portion, your share, right? And for book value, you have to add with your reserves. It was something 43.3, right? Even higher than this. Right? So it is just very simple, right? When you have to take the book value, you don't have to multiply by 2.6 or you don't have to divide by 0.5. You just have to take from the balance sheet this value, 1205. Your shares plus reserves, the book value. From the balance sheet itself, you have to take the value. Whenever the market price comes, then only you have to do this change calculation. But book value, you can directly take from the balance sheet. So it will be, your non-current liability will be 920 only. Here also 920 plus your reserves plus your shares, which will be 43.2 something. So round it up, it will be 43.3%. Exactly the figures we got here. Just check here, right? This one and this one. So just check for the other years also. Are you getting it or not? Now let's go to the investor. Your EPS, DPS. All this has been given to you in your, this has been given to you itself. So you don't have to work out on your EPS and DPS. Dividend cover. Now you have to work out your dividend cover. How will you work out a dividend cover? Have you been given the formula? Have you been given the formula? You are not given the formula anywhere. So that's why now it is the time for you to memorize the formula. You should know the formula because you don't know what formula where you have to use. So it's always better to remember all the formulas and come for this exam. Dividend cover is your EPS divided by your DPS, right? So your EPS has been given, DPS has been given. That means Here I will calculate 0.15 divided by 0.075. You should get 1.98, right? Dividend cover. Your EPS divided by your DPS. If you divide this, you are getting 2, right? But here they are getting 1.98. Why is that difference? Maybe they haven't used this EPS and DPS. Maybe they have got their earnings per share and dividend per share. Meaning, maybe they have got to the income statement and got the earnings and the dividends from there. Right? So let's go and get the earnings and the dividends. Earnings divided by dividends. So what is your earning? Your earnings is profit after tax. Profit after tax is your earnings. Divided by dividends. So it does not matter dividend per share or earnings per share. Now you're taking earnings divided by dividend. It's the same thing only. So your earnings is 119, dividend is 60, you are getting 1.98. So you use the EPS divided by DPS, earnings or dividend from this income statement. This and this. Use this too for finding your dividend cover. Don't use the ones which they have given there, because that will be more accurate then. Right? This 1.98 is more accurate than 2 by using this 2. This dividend cover is more accurate. So you're done. Now the market price per 0.5. So all you have been given. This 3 also you have been given. You just have to copy paste here. You're writing it here so that it's easy for your calculation purpose. Otherwise you have to refer, each time you have to refer back to the table to check what is the market price, what is the market price. That's why when you calculate ratios and all, always write all the numbers in one place. Keep all the numbers ready. EPS, DPS, dividend cover, dividend yield, market price per share, share price gain or loss, everything in one place. It's easy for you to work out. Now, price earnings ratio. Why this market price is written here? Because your next PE ratio, price earning ratio, you need to calculate. EPS, price earning ratio, dividend yield, share price gain or loss. These 4 ratios are very important. It has to be there for investors. You need that price. You need that price for your EPS ratio. That's why it's given there 2.76, 3.49. So what is your earning ratio? Your earning ratio is the same as your this one. Earnings per share, earning ratio, same thing only. Right? Don't break your head to find this earning ratio. Where is earning ratio? Earning ratio. This is your earning ratio. Earning ratio, they are the same name, right? One thing, but two different names. So when you're finding your PE ratio, what is your price? Price is 2.76, right? So here it will be 2.76 divided by your earning ratio, that is 0.15. Hence you are getting 18.4. That's how you have to find for the other years also, right? One thing, okay, first I will calculate all and then we'll see. Now, dividend yield, whenever you have to get this total shareholder return, right? This you have to get. Always try to get total shareholder return as a percentage. How will you get? You need this, then only you will get this. That means you need dividend yield percentage, you need share price gain or loss. This too you need to calculate to get your total shareholder return. So first we'll go by the dividend. Anything you can calculate first. So dividend yield, the percentage is given. Formula is given of dividend yield. Dividend per share divided by share price. So what is the dividend per share? It is given as 0.075 divided by the share price. That is 2.76. Right? It's as a percentage you have to take. You have to multiply your answer by 100. Then you will get 2.72 something. right? And then share price gain or loss. How much your share price gain or loss? From here itself, you can work out from 2 point, no, for this, right? For 2001, you need the previous year share price, the 2001, right? How was the share price in 2001? It was 2.5 to 2.76. How much it changed? 2.76 minus 2.5 divided by 2.5, right? 10.4%. It increased by 10.4%. Likewise, for the other years also you can do. So it increased by 10.4. That's why it's in positive. So you just add and you're getting the total shareholder return also 10.4, right? So this is also done, this is also done, this is also done. Now let's go to the types of products. Now they are dividing it according to the types of products. So electronic toys, other toys, and clothing, right? What is the percentage increase in revenue? This also you can find, but you just have to go under that selection of electronic toys, other toys, and clothing. Separately, they have given according to the types of product what is the revenue, what is the gross profit. So from there, you can find the increase in revenue, gross profit margin, also increase in gross profit. The same way for the others also, other toys and clothing, you can find out. Now we'll analyze this. Just see what's happening to the profitability. 18.1 to 17, it reduced. Revenue is reducing. The percentage increase in revenue, the general, right, together of all the products they are taking. Then the gross profit margin increased very slightly from 27.5 to 27.6. It remains same in this and this year. You need to analyze like this before you write your discussion. First you have to check the numbers. Otherwise, then only you have to start your discussion. What's happening to the increase? Gross profit is not increasing. There's a reduction from 18.4 to 17.1. Operating profit margin also increased very slightly, very. Your operating profit increase is not, it's declining. Asset turnover is increasing. ROC is increasing. Current ratio is not good, 0.64, right? It's declining. Solvency, if you see, gearing based on your market value of share, not good. It's good, it's reducing the gearing. And here also the gearing is slightly reducing using book value. And the interest cover is also same from 4.5 to 5 and then 4.5, which is not so good. EPS is increasing. DPS is also increasing, not too much. Dividend cover is slightly increased, right? Market price is increasing. Price earning ratio increased, very slight. The change is not so big. Dividend yield decreased. Your share price gain also increased, and total shareholder return also increased. Now let's go according to the types of product. What's happening to the electronic toys? If you see, the percentage increase in revenue is not good. Gross profit margin not good. It's declining. There is no increase from 12.1 to 1. It's a big change. Whenever there's a big change, please always, this definitely you have to put in the answer in your discussion. In the beginning few sentences, whenever there's a very big change. For slight change and all, it's okay. Right? This is not good. Electronic toys. This is a major concern because you are going to invest in electronic toys, right? That's what they told. Now let's go to the other toys. Other toys, if you see, revenue decline, gross profit increase, very slight increase. There is no increase in gross profit. Clothing decreased by 0.1. Gross profit percentage, the increase is not so much, and also there is slight increase in gross profit, right? So now we are going to discuss this. The way you started your ratios is better the way you put your discussion also. You started with profitability. So you are going to discuss also with profitability. It's better to go in that order. I always follow consistency. Please follow the consistency. It's easy for you. Because your mind automatically knows after profitability what comes. Then liquidity, then solvency, then investor, then your other ratios if you want to talk, and your conclusion. So first we are going to talk about the profitability ratios. Right? Zoom it a little. Okay. So Tillinton Company's chief executive is correct in saying that the absolute increase in revenue and gross profit on all products was greater in 2003 than 2002. but the percentage increase in revenue was smaller on all products. Right? That percentage increase was not so good, but yes, there was an increase, absolute increase. Even though that increase is very minute, but he's correct. That was chief executive was saying, right? You have to start like this because you have to analyze based on whom the chief executive's announcement, right? His statement and the concern of who was it for? I forgot the name of the person, right? So there was another person, I forgot that name. He was concerning the share price will not increase. So based on these two persons, we need to evaluate the profitability. Okay, so here he's correct. But the percentage increase in revenue was smaller on outputs and the percentage increase in gross profit on toys was also smaller. The percentage increase on electronic toys was the biggest fall. See, I told you, whenever there's a biggest fall or biggest increase, that has to be the first paragraph, first line itself. Because that shows the importance of it. That's the very important thing. Your most important thing, most significant thing, you always, when you divide into different paragraphs, what to write in each paragraph, the one which is going having the biggest impact has to be shown in the first paragraph itself, right? So percentage increases on the electronic toys because electronic toy is the one where you could invest. So if that shows the biggest fall, that's going to be a very great, possibly indicating what they just didn't start that it's a biggest fall, greater competition. Now every company is going for that electronic toy. When there's a sudden fall, huge fall, it implies that there's a greater competition. Now let's go to the second paragraph. The improvements in operations mentioned by Chief Executive have maintained gross and operating margins and resulted in an absolute overall increase in gross and operating profits. Yes, absolutely there is. Because they told that they're going to improve the operation. So operation is all about gross profit and operating profit margin. So absolute there's an increase. However, this aspect of performance is almost all attributable to the Tilton company's older products, right? They are saying the performance which is coming is from the older products, not that electronic products, because that is facing the biggest fall. So the gross profit on electronic toys have hardly increased and the gross profit margin has fallen over the last 2 years. All this they are just saying based on the calculations. There's nothing new piece of information. Is the margin, although the margin remains higher than on the other products, right? Even how they are saying margin remains higher than on the other products. Oh, you okay, understand. Even the 2003 margin may not be sustainable, right? Even though that margin is higher, they're saying that 2003 margin may not be sustainable. If competitors are starting to catch up with the Tilden company, then the profit margin on the current range of electronic toys may continue to fall in future years as prices fall to maintain market share. Right? They're saying now they're talking about the future. What happens when more and more competitors come? There will be greater fall in the profit margin. So despite the emphasis on developing the products, the revenue generated by electronic toys is still below the revenue generated by non-electronic toys. Just go and check. I'm going to take you to the figure. Just check to the revenue. Right? Or maybe we can just go to the this. Right? Just check for clothing. It is around 200, 250 something, 310. Right? This is very less, very less, very less compared to the electronic toys. So from other products, other toys, you are getting more revenue, more gross profit. Even in the, when you check this here, the revenue, just check 834 where is 249, 302 where is 249. So from your non-electronic toys and clothing are getting higher revenue compared to electronic toys in all the 3 years. Right? So your gross profit, yeah, so that's what that means. From older products, you are generating a higher revenue. The gross profit on electronic toys has hardly increased and the gross profit margin has fallen over the last 2 years. We saw that for the electronic toys. Although the margin remains higher than on the other products, Even the 2003 margin may not be sustainable. If competitors are staying to catch up with the Tillinton, then the profit margin in the current range of electronic toys may continue to fall. Despite the emphasis on developing products, revenue generated by electronic toys is still below the revenue generated by non-electronic toys. Right? In just one paragraph, they are saying in one line. They're comparing the revenue. So it's not only important that the ratios which you already calculated you need to compare. You still can take ratios or the numbers, the figures from the income statement or balance sheet and compare, like how they compare revenue here. Right, this revenue has been given to you by the question from the case study. You didn't do any calculation. So this also you can compare and talk that electronic toys revenue is less than the non-electronic toys. Now they are moving on. Now just see how slightly they are moving from next paragraph to the next. Right, they are going from here. They talked about all operating profit, net operating profit, and then they compared. Now they are talking about here asset turnover and return on capital employed in the next paragraph. That's how about each topic, each ratio you need to discuss in different paragraphs. Let's say if you're talking about gross profit, operating profit margin, they can be combined in one paragraph, right? Because there's no use of separating it. Then when you talk about asset turnover, it could be in another paragraph. When you're comparing non-electronic toys with electronic toys, that can be in one paragraph, right? It does not matter whether your paragraph is in one line, it can be, right? So the minimum could be one and the maximum is 5 lines. Don't exit per paragraph. It should be at least 5 sentences if you're writing so, but it should not be more than 5. Now let's see. So now they are talking about asset turnover and return on capital employed. They have risen significantly over the last 2 years, right? We saw that it increased from 2001 to 3. However, the part of the reason for the 2000 increase was the significant increase in current liabilities. We saw that current liabilities increased. Why they are saying that because of the significant increase, asset turnover, return on capital employed increased? Go to the formula. Formula of asset turnover is total assets minus your current liabilities. So greater your current liabilities, lower will be your denominator. A bigger portion of your current liabilities is being deducted from your total assets. That means your denominator will become smaller and smaller and smaller. When your denominator becomes smaller, the number will increase. Asset turnover will increase. Right? The further amount of investment which the chief executive appears to be contemplating suggests that asset turnover and return on capital employed may fall in future years, particularly if profit margins on electronic toys cannot be sustained. This is very important. Based on the increases, you cannot say that it is wise to go ahead with electronic toys. This increase in ROC and asset turnover may not be sustained in the future. It may fall in the future if profit margin, see currently profit margin is low, right? It's decreasing on the electronic toys. If it cannot be increased, then your asset turnover and ROC will also be affected in the future. This you need to talk about. Now let's go to the liquidity ratios. Right, liquidity ratios is not so much of this. It's very easy and straightforward to understand also. It just has one ratio, that is your current ratio. So the figures for the other assets seem to support the chief executive's contention that working capital is being managed better, as other current assets are falling as revenue and gross profits are rising. However, the fall on the current ratio from 1.5 to 0.6 is significant. And the biggest reason for the fall was the large increase in current liabilities. We saw current liabilities increased. There was the biggest increase in 2003. Go to the balance sheet and check your current liabilities. It increased from 2002 significantly. That's why there's a fall in current current ratio. So cash balances have remained at a low level despite higher revenues and profit. Possibly there is now a bank overdraft, which could have contributed to the significant increase in finance costs between 2002 and 2003. Let's go to the balance sheet and see. Right, let's go to the balance sheet. Okay, So we have, just look at your cash from 10 and then 15, 15. It then increased. Current assets declined, right? So but your current liabilities is increasing very significantly. So there's a chance that there's a bank overdraft in that current liabilities, because we are not given the proportion of current liabilities, how the current liabilities has been made. So they're saying that there is possible that there's a bank overdraft now. All right. It would seem that cash reserves have been exhausted by the combination of investment in non-current assets and the payments to the finance providers, right? Because the cash is same, cash is not increasing. So what does it mean? It, right? It would seem, see the word I told you when I was discussing question 5, always the words has to be maybe, perhaps, would, such words you need to use. It would seem. Don't just say cash reserves have declined because of this. You are not very sure why it happened, but it's better if you use such sentences, such words. It would seem. It might be. It could be. Possibly this is why cash reserves reduced or something like that. You can write like this. There's a way of writing. So it would seem that the cash reserves has been exhausted by the combination. We saw from 10, 15, 15. It remained the same. There's no increase in cash. Why? Because it might be there's a combination of investment in non-current assets. So for that we need cash, and the payment to the finance providers. Yes, from the cash we have to pay the finance provider both interest and dividends. And Tilton company is more dependent on short-term liability finance. It is more dependent on, see, it is not wrong to say this, because you can see that there's an increase in current liabilities. So they are more dependent on short-term liability finance. Slowdown in any product area, particularly electronic toys, may result in a significant liquidity problems. Right? Now let's go to the solvency. So gearing has fallen over the last 2 years, but this is due to the share price increase, which may not be sustainable. So how are they saying that gearing has fallen because of the share price increase? Why? Why will it happen? Okay. Go to the, always whenever some increase and decrease, if you want to find a reason, it's always better to go to the formula and check the numerator and the denominator. Your answer lies there. That's the shortcut. That's the tip I can share with you. I always used to do that. You don't have to go anywhere. Why that increase, why decrease? Always go to the formula, from itself you will get the formula. What is the formula for gearing? Non-current liabilities divided by non-current liabilities plus market value of share capital. So non-current liabilities, don't touch it. They are talking about increase in share price. That means only share capital you have to talk about. So when your share price increases, that means your share capital will increase. So that means your denominator will increase. When your denominator increases, the number in the bottom of the fraction, your number will automatically fall down. You can try this with some imaginary numbers and see. Maybe 1, 2, 3 like that. Increase the denominator and check how the answer will fall down. So that's it. That's why that gearing fall down. The more the number increases down, the number will fall. So that's why they are saying, and we saw that the share price is increasing, right? And even this increase in share price may not be sustainable. That means gear is falling now, but it's not correct to say that gearing will always fall down. Even in the future, it will keep falling. No. If the share price does not increase, if share price starts falling down, gearing will increase. If book values rather than market values are used to calculate gearing, the falling in gearing is much smaller. Just check the falling using both market and book values and see which falling in gearing is smaller, the book value or the market value. So more information is needed about an additional 30 million in the long-term loans. Additional 30 million in the long-term loans. How are they talking about this additional 30 million long-term loans? Just go to the long-term loans and check. From 920 to 970. It increased, and from 970 to 1000, so the difference is 30, right? 30 million. So how that long-term loan increased from why 30 million? More information is needed. No information is given in your case to understand, for you to know why it increased. So that they are talking about that additional 30 million, right? Although cost on this may be higher than on his current loans, This would not account for all the increase in the finance cost as discussed above. Tilton may be making use of overdraft finance. So they are saying that all this additional loan will not account for increase in finance cost. Why? Maybe they are making use of overdraft finance, right? The fact that current liabilities have increased much more than the non-current liabilities. The fact, just check your current liabilities and non. See how much analyzing you have to do. How much figures from what angles you have to see the balance sheet. If you practice this question now, if you practice this kind of question only in the exam, when this question appears to you, you know what you have to do, from which angle you are seeing, from which angle you have to see, how you are going to compare, analyze the balance sheet items. Just check the current liabilities and this would be an indication that Tilton company is having problems raising all the long-term loan finance which it requires. Everything will never be given to you straightforward and say this is happening. You need to analyze why that increase, why this increase. Just check your current liabilities and non-current liabilities. Your current liabilities are 105 to 220, right? That increases more, maybe some 100 or 15. From 126 to 220, that increases more. But long-term liabilities is just by 30 million it increased. So that means that increase in current liability suggests that maybe they are having problem in raising that long-term loan, right? So the figure suggests that Tilton Company Board needs to review a future financing carefully. Because of this change, they need to review the future financing carefully because of that figure. If the company was to make further investment in electronic products, see, if you want to make investment in electronic products, think practically. Is it suitable for you to rely on your short-term loans, current liabilities? You are investing in electronic products. It's a huge investment you need there. You cannot rely on your short-term finance. You need long-term finance. You need bank loan. You need long-term finance. So for that, you need to review your future financing carefully based on today's figure. If you want to make an investment in electronic products, at some stage, the board still have to consider raising further finance, as I told you, either through an issue of shares or through selling of parts of its operations. If you cannot take a loan, maybe you have to sell some of your shares or through selling part of the operation. Now let's go to the investor ratio. Right? Both earnings and DPS have risen since 2001, which could have explained the significant increase in share price, right? Because EPS and DPS increased, this will help to explain why there is a significant increase in share price. Because if your EPS and DPS increase, only your share price will increase. So dividend cover has remained around 2 despite an increase in earnings. Although dividends have increased, dividend yield has fallen since 2001. The increase in total shareholder return is due solely to the increase in share price. You see that your share price has increased significantly, but your dividend didn't increase that much. That's why you are saying that the increase in total shareholder return is due solely to the increase in share price, which has also resulted in the price earning ratio increasing in 2003. Because of that increase in share price, your PE increased. PE will increase when share price increases. Because just check this price. Share price or price, they are same only. Your numerator is increasing in the price earning ratio, price. So when price increases, PE ratio will increase. The current rate of share price increase does not appear to be warranted by the most recent results and may be partly due to generous dividend levels, which may not be sustainable if more cash is required for investment. See, they are saying that it is the current rate of share price does not appear to be warranted. Maybe there could be some increase in dividend yield, but they cannot increase that dividend because they have to use the cash for the investment. If they use the cash for the investment, how can they pay dividend? They cannot increase the dividend, right? That means they solely have to rely on the current share price, the share price increase. And that share price increase is not warranted. Now let's go to the conclusion, right? So, despite the chief executive's optimistic message, yes, they have been very optimistic that their results are good. In the annual report, the benefits from the electronic toys development may be short-lived. There appears to be a mismatch between the investment, dividend, and financing policies. As discussed, margins on current products may fall further, and there is no guarantee that margins on new electronic toys or other products will be high if competition generally is increasing. Of course, when competition increases, your margins is not guaranteed. Your margins will not increase so much. It will fall. So further significant investment in electronic toys or other goods. So what was your major decision whether to invest in electronic toys or not? Based on that decision, now you can tell whether you have to invest or not. So further significant investment in electronic toys or other goods may be difficult to finance. Just difficult to finance. Increased reliance on short-term finance is clearly not sustainable, but obtaining more debt may be problematic. See, you cannot rely on short-term sales because it's a major investment. You cannot even obtain more debt. If you obtain, there'll be a big problem. Your gearing will increase. High finance costs. Okay, it will be highly you need to pay finance cost. So all these things you have to take into account. Currently, your liquidity position is not good. So if you have to pay more finance, if you have to pay more interest to your debt holders, it's not possible here. It will affect your liquidity position. Also, your profitability margins is not increasing so much, right? So particularly if gearing level rises as share price falls. If share price falls, gearing level will increase because share price is the denominator, right? So Tilton company seems reluctant to take advantage of high share price levels to issue the share capital. So they're saying that because the share price is increasing, high share price, now they can sell off their shares. They can take advantage of that to issue share capital. So this plus the increase in dividends may indicate Tilted Company's board is unwilling to risk upsetting shareholders despite. So now there's an increase in dividend and also the share price is increasing. So this is currently it is benefiting the shareholders. So the Tilton Company's board, they don't want to take any risk of upsetting their shareholders because currently they are doing well. Dividend is increasing, share price is increasing. So they're unwilling to risk upsetting shareholders despite the large increases in share price. The chief executive may be right in saying that funds may have to be obtained by selling off one of the other parts of the business. But revenue and profits from the older products may be more sustainable. Just see how they are evaluating. In one you are saying yes it is possible, you are giving advantage, but the other way same time you are coming up with the disadvantage. So this is how you need to evaluate. First you are saying okay, it is okay to say that you can sell off one of the products, but what are the repercussions, what are the effect of this selling of part of the business? The effect is that your revenue and profit from the older product may be more sustainable. We saw that there was a large fall in gross profit margin in your electronic toys, but from the other toys that decrease was not so much. Your revenue and profit from the other products, clothing and non-electronic toys was high compared to electronic products. So if you sell off those other non-electronic, you are missing out. You're losing the revenue and the profit from those products. So that is the problem. You cannot use this. So an increased concentration on electronic products may be high risk strategy. It's a high risk strategy if you are increasing the concentration only on electronic products, because first of all the revenue is very less compared to other. We saw from 12% to 1% the revenue declined, the profit declined, right? And also there's a major investment in electronic products. It's hard to finance that. There are so many disadvantages. So possibly if investors become less positive towards the electronic goods sector, they may realize this, resulting in an increase in cost of capital and fall in share price. What does the last line mean? If investors become less positive, that means they are not taking this in a good positive light. If investors do that, what happens towards the electronic goods sector, right? This will increase the cost of capital. Why it will increase the cost of capital? Risk is increasing. Risk. And fall in share price. Share price will fall. When a sector is good and investors want to invest in that, the share price will increase. But when an investor does not want to invest in that sector, right, they feel that it's not a good strategy, high risk strategy, share price will fall. That's how it works, market works. So now we are done with part A. By now you must have understood how to calculate ratios and how to interpret and how to discuss, how to evaluate a given decision and how to come up with the solution. Now we are going to part B. Part B, we are going to talk about the 5 behavioral factors why the share price is high. right? In that electronic sector. So if you see 1, 2, 3, 4, right? There has been 5. So let's see 5 factors. Tilton company shares may be overvalued because share price generally are too high, right? They're generally too high. The situation may be a stock market bubble. It is possible. There could be a stock market bubble. That's why share prices are too high. Share prices have been rising consistently recently, and this could be encouraging investors to buy more shares. If share price rises consistently, what happens to the investors? They are now more encouraged to buy more shares, further increasing the share price. Now let's go to the second bullet. Second point. The bubble could be more localized. Limited company seems to be positioning itself as much in terms of producing technologically advanced electronic products. See, when this mostly this comes, this behavioral factors and the share price, they link, especially in this kind of sector where the share price is increasing, especially this technological sector, electronic sector, all this kind of sector, right? It does not come for all the sector. So in the exam, when you are given this kind of sector, make sure that you write these points because the points are almost repeated in all the papers for the behavioral factor for this kind of sector, right? As manufacturing toys, they want to position themselves as technologically advanced electronic products as manufacturing toys. So the electronic goods sector may be more likely than any other sector to attract investors. Correct, it's true, right? We are more attracted towards electronic sector on the basis of future profit potential. We assume that in the future the profit will increase. We are going to get a higher profit from this sector. So based on that assumption, we go and invest in electronic goods. So the share price increases. So with investors possibly following a herd instinct, please use these terms. If you don't use these terms, you're not going to get marks if you just write general points or generally you are writing sentences. You need to use these terms. These are behaviorable factors. This you need to write. So they were possibly following herd instinct. What is herd instinct? It's given here. Investing because others have been investing in the expectation of future gains. It's how when behind a group, when one person is doing something, others automatically they want to do something. They want to try it. Now let's go to the other one. Possibly investors are more persuaded by the chairman's confident language. It is possible that they may be persuaded because the chairman is very confident. The chairman's confident language and future promises than they are by the concerns the figures suggest. So they are more persuaded by the chairman's confident language than the concerned. So they may also be paying excessive attention to the most recent set of results rather than seeing them in the context of whether they may be sustained in the future. If investors are attempting to make a valuation, they could prefer using a model which confirms what they believe the shares are worth. The confirmation bias is very important. Again, this word needs to be used. What is confirmation bias? What is confirmation bias? You're always looking for you are seeking for those information which confirms that your decision is right. If you know that something is not right, your decision is not right, right? The evidence suggests that your decision is not right, you tend to ignore those. You want to confirm, so it's known as confirmation bias. There's a bias in that. You only want to look at those information which confirms that you are right, not the ones which confirm that you're not right. Rather than one which gives a more reliable indication of a value. As discussed above, shareholders may be basing their estimates of value on the recent increase in dividends, even though it may be doubtful whether this is sustainable. Right? Read more on behavioral finance. So that's it for today. So we have discussed all kind of ratios: profitability, liquidity, solvency, gearing, investor ratios, and the trends, and also we have gone through the behavioral finance. So I hope this is a very useful video for you. Hit that like button if you have found this useful, and share this with your friends, and don't forget to subscribe to my channel. Right, my channel is going to reach the 200 subscribers. I'm waiting for it. Thank you and take care.